Well, hello, this is Jim Musgrave with Research Financial Strategies, and this is your monthly market call. And I'm recording this on July the 1st, 2015. And I want to start off by a report that JP Morgan put out called Pre-Gaming the Tighter Fed. And this is actually a good report. I want to start off with 4 points that they make in this report. One is that the Fed is going to be on track to raise interest rates most likely sometime this fall. When it happens, it'll probably be maybe 25 basis points. It's not going to be a huge rise when it happens. And so Yellen will probably raise the interest rates fairly slowly. And again, the time to adjust your portfolio is before the Fed starts tightening. But the market's really been kind of building in a lot of this over the last year or so. And so we've been adjusting the portfolio, and I want to go more into that in just a few minutes. Bear markets and bonds tend to be less fierce than stocks, and that's true. You know, we've been in a bull bond market since the early 80s, but that bull market has now ended, and it is starting to flatten out, or we're not really in a bond bear market at this point, but interest rates going up and yields going up. Now bonds have certainly struggled a bit, and the bond index is down roughly 1.2% year to date. But with that being said, we still feel that there is room for the U.S. equities to grow, even though security selection is more important than ever. And I think this is absolutely critical. It's very important what you don't own as well as what you do own. So let's go back to the first point on why the Fed is going to be raising interest rates. Well, they raise interest rates because economic data is improving. So if you were to make a case for being bullish or being positive, here's my argument. Okay, so we have light vehicle sales are continuing to improve, housing starts are continuing to improve, real capital good orders, unemployment is also going down. There's more jobs out there. And so, things are just slowly feeling better. And so that is a positive thing. But as I mentioned, that with the market trying to figure out where the interest rates are going, that is really what's caused a fair amount of volatility. And so here's the 10-year Treasury index, and you can see right here on January 1st, we started here, and this yellow line is straight out, and so you can see that it's been a very volatile year for the 10-year Treasury. So as the 10-year Treasury goes up, then our bonds are going to drop. And you can see that as it years, again, this green line right here is the part of our market forecast intermediate line. And so when it's above 80 right here, that's very bullish. If it's down below 20, that's very bearish. So you can see that's kind of been all over the place here in the first half of the year. And so you can see that the 10-year Treasury yield has gone up, and actually the bond index has dropped. And so these parallel black lines that are going down, that's called the linear regression channel. And you can see that's tilted from upper left to lower right. That means that the momentum has turned negative. And you can see that the bonds, although they've been volatile, have lost a lot of steam since maybe the first week in April or so. So you can see right here, starting in early May, the bonds have been very bearish, and they kind of have remained that way for the last couple months right now. So that's where we are with the bond market. Let me just go ahead and talk about the stock market for a second. The stock market is really interesting. We've been in this trading range since February, and I drew all these lines. I'll explain what they are. This line right here, this is where we started on January the 2nd, and the market ended the second quarter exactly where it started. Today is July the 1st, and we had a little bit of an update today, but you can see that the market has been absolutely flat. We had a bit of selling in January. We had a nice little rally here in February, more volatility. But we've been in this trading range, seems like forever. So this center line right here is at 2100, and you can see that the market goes above 2100 and then pulls back. It hits a support level and then goes back up, crosses 2100 and drops down. And it's done that 1, 2, 3, 4, 5 times in the last, 4 months. And you can see now with this Greece situation going on, that's caused a little bit of turbulence in the market. And we had this big, huge sell-off on Monday, which is about a 2% pull-off, sell-off. So we broke that 21-day, but now we're starting to go back. And so the market tends to be really driven by what's going on in Greece. When the days that the market has gone up, they were hopeful that Greece will have some sort of deal with IMF. And when things start falling apart, that's when the market drops. And so, again, the market is kind of in this range, kind of being held hostage by what's going on in the Greek situation. But you know what? If we break the support that we hit right here, the next level support is right here at 2040, which happened back here in mid-March. And even if we drop to that, the market's only down 4.4%, and that's really very normal. That's not a big deal. So let's say the market drops even further. The next support level is this little candlestick right here back on February the 2nd, and that's at 1980, and even that is only an 8% drop from the all-time high at 2134. So, I mean, we are long overdue for at least a 10% correction, and I'll show you that. So you have to go all the way back to 2011, where we had a 20% drop here, actually right around this time of year in July, and it kind of peaked in early October. So you have to go back a number of years to 2011 until we had a significant pullback, and even that wasn't a true bear market because it didn't hold for that long. So we are certainly overdue for at least a 10% correction. That doesn't mean we're going to be in recession mode or that it's going to continue further, but the market actually needs that. So if I were to have a bearish case, well then what's my case that the market's going to drop further? Okay, well I'll give you my bearish case. One is that so we've got this trading range right here, and we have been able to get past this this resistance. If I put us on, let's say, a 1-year chart, you can see that the 200-day moving average, which is this purple line right here, is getting narrower and narrower. And typically, when the market crosses that 200-day moving average, if it holds, then that tends to be a fairly bearish sign. Now you can see back in October the market broke that threshold of the 200-day moving average, but you can see just within 5 or 6 trading days it reversed right back and went through it. So that could happen again, but this is not a good bullish sign when we're getting close to 200-day and then we're just kind of going flat. That's not that's not very good. And you also look at my market forecast, you can see that the market has certainly turned more bearish. Now we're not down here below 20, and we're certainly not down here in single digits. I mean, we got down that way here last October, but we're not there yet. And so, yeah, again, we've had a bit of a pullback, but we're not to the point where we're starting to get completely defensive and selling a bunch of positions because we think that the world's going to end. So we're just not at that point right now. Now, what's interesting is that if you look at a couple other sectors, one is that here is small cap. And small cap has performed actually a little better than large cap year to date. So here we are at the start of the year, and you can see small cap has done fairly well. And this is actually somewhat of a bullish sign because typically when things start looking ugly, the small caps tend to lead first, but that's not happening right now. One of the other things that I want to kind of show to you, which kind of puts me possibly in a slightly bearish camp, is the transportation index, IYT. And here's the philosophy, okay? Everything that you consume gets to you by either a plane, train, truck, or a ship, or a car. And so if the companies like FedEx or UPS or CSX, the trains, or the shipping companies, if they aren't doing as well in terms of their stock prices and they aren't as profitable as they have been, then that is a leading economic indicator. And if you look at IYT, you can kind of see that it peaked up here at the end of the year and it's just kind of slowly lost steam. So that is not a terribly bullish sign. That's somewhat in the bearish camp, and you can kind of see that the transportations are really kind of down here in single digits, and that's absolutely a bearish sign. And so those are some things that we look at in a short-term perspective, but I also want to kind of show something from a more longer-term perspective that kind of gives you an idea of what's going on. Advisor Perspectives is a great website that we use to look at a lot of technical stuff. And they came up with an article recently, and I can email this to you if you have interest, but it has a correlation between the margin debt growth and the S&P growth. And you can see as margin debt growth increases, so does the S&P. Means that people are going to buy more stuff on margin when they starting to feel good. So you can see that this is when you're looking at a negative credit balance, you can see that they are inversely proportioned to the S&P. So you go back here to 2000, to 2 recessions ago. We had a huge negative credit balance here, and the market was going up. So that was what preceded the bubble bursting in August in 2000. And we also, then the market rallied, and then that started to happen again, and that kind of peaked in June 2007 when the market was right before the latest recession back here in 2008. And you can see record numbers of negative credit balance right here where we are in the market. And if you look right here to the negative credit balance versus the inverse of the S&P, they are directly correlated. So this is not telling me that a recession is going to happen tomorrow. What it is telling me is that we are long overdue for a pullback, and this is something that we don't know when the major pullback is going to hit, but the conditions are certainly getting riper for that to happen. So the way we're handling this is that you have to be bullish because the market's still going, but at the same time is that you really have to keep this in mind and definitely have some sort of strategy for when the market takes a big dive. You can't just keep your money in the S&P 500 or whatever mutual funds that you have and assume that you're going to be okay when the next bear market happens. It's just, we've seen this story over and over and over again. So a lot of investors have been kind of in this complacent mode where hey, we've had some good returns for 5 or 6 years, and I'm feeling good, and I'm not worried about it. I'm going to be fully invested, and all is good. That's fine, and the bottom hasn't fallen out yet, but you need to be aware that the conditions are getting ripe. And I've been saying this for years. And you may be thinking, hey, Jim, you've been saying this for years. The market keeps on going up. Well, that's kind of the definition of a bubble, is that the signs are there for months or even years, and by the time and at the point that you feel good and you're ignoring the bubble, that's when it bursts. So I'm not saying that the bubble is going to burst tomorrow or even this year. I'm just saying that the conditions are getting ripe, and you better have a strategy to protect your principal for when that happens. We do have a strategy, and we have our exit points on every single position that we have. So that's just something I just want to kind of share with you in the grand scheme of things. So I'm just kind of wrapping things up. Going back to the SPX, again, we're in this narrow trading range. It's going to be that way. Again, the market's driven by Greece right now. If we have a pullback right here, it's not the end of the world. If we pull back below the support, again, that's to be expected. If the market pulls back more than maybe 11 or 12%, that's the time that you really need to start raising an eyebrow and say, okay, is this a short-term thing or more of a longer-term trend? And so we're always, if you're one of my clients, you're going to know this stuff before it happens. If you're not one of my clients, the best thing I can tell you is to watch my monthly videos each month, or give me a call, visit my website, contact me somehow, and I'm happy to review your portfolio and kind of show you where you are taking risk and how you might be able to minimize the risk when you have these pretty volatile and potentially very dangerous markets. So until next month, listen, you guys have a good month of July. I hope this was helpful. And I'm going to sign off, and you guys have a good 4th of July weekend. And we will talk to you next month. All right, take care now.